What happens if you run out of money in retirement? What are you going to do? Are you going to have to go get another job and go back to work? That's something that we always want to prevent. One of the common questions associated with retirement is, how am I going to generate income in retirement? What can I do that is safe, that is going to be consistent, to guarantee me some predictability? So in this video, we're going to cover all of that. We're going to cover the potential retirement income streams, potentially what amount you may need, and answer some of your questions. So to start off with, one of the questions I get, I actually just got the other day in a client meeting, is, how much do I need in retirement? I heard you need $1 million. I heard you need $3 million to retire. How much do I actually need saved up? That's a tricky question because it really depends on your lifestyle and your specific situations. I'll have people come in and they'll throw out an amount and it's actually they need more than that. And then I'll have vice versa. I'll have people come in and say, I need 5 million to retire, and quick analysis of the numbers realize, no, you don't, you need 3 million. What are your expenses, and what are your expenses going to be in retirement? How much are you actually going to need in order to live that comfortable life that you want? The other is your risk tolerance. How are you with risk? Are you just deathly afraid of risk? And then some of the other things that you need to know are liquidity. If you have this lump sum of money that is generating you income, is there a situation where you're going to ever just need to go in and access a large chunk of that sum of money? These are all very important things. And there's a lot of misunderstandings, misconceptions about various retirement instruments. People will say, oh, this instrument is bad, or oh, this instrument is good, when in reality, it really depends on your understanding of them and your situation. We hear that a lot. Annuities can be bad. And to be fair, there are a lot of bad annuities out there. At the same time, if you are fully understanding of what you need and understanding of what a given annuity does, there can be ones that are good for your situation. That's the same with bonds. That's the same with mutual funds. That's the same with CDs, all that stuff. So crafting a solid retirement income stream, what do you need? We'll give a hypothetical here. Let's say you've got $1 million saved up. How much are you going to need? Let's say you need $100,000 a year. What's important to understand, if you need $100,000 a year and you've got $1 million, you're pulling out 10% of your portfolio each year. I know what some of you are probably saying, oh, the S&P over the last 30 years, it's grown 11% a year. Okay, but that was the last 30 years, first of all. Past performance does not equal future returns. Second of all, we need to have an understanding of, do we have 30 years to make back that money? Because it may take that long. An example I give in a lot of my educational events, if you would have started investing in January of 2000, and let's say you were in the S&P, just straight up in a S&P 500 index fund in the stock market. By 2010, we're not even including any distributions or anything, you would have lost 12%. So boom, that 10-year period, you're down 12%. That would have taken some time to make back up, about 4 or 5 years, and that's assuming you weren't pulling from that money. Let's say the stock market goes down 10% in a year. Let's also say you're pulling 10% from your portfolio. Your account balance is now down 20% in that year because 10% went down from the market and the other 10% you pulled for income. So now you're not having to make back that 10%. You're having to make back 20%. If you lose 20%, how much do you need to make back in order to get back to even? You lose 20%, you got to make back 25% just to get back to even. The more you lose, the higher that figure goes up. The best way to prevent this situation is to invest in things where you're limiting your downside to an extent. However, the other thing is that, start at the beginning. Remember, we said you have $1 million, you're pulling out 100,000. A 10% withdrawal rate is generally considered to be high. The golden rule is 4%. We want to be in that 4 to 5% range. If you need $100,000 a year, $1 million in your account is probably not enough. So the way to figure out how much we need is take a look at your expenses, per month, multiply that by 12. Now we've got an annual expense number. And then we want to take that number and figure out, okay, if I need to pull out 5%, do some easy division, and then boom, we can get our base number that we need. That gets us to our next point. What instruments should I use? Should I use CDs? Should I use bonds? Should I use annuities? Again, we get back to that liquidity question of, are you okay with just having this money set aside? You're not going to be able to touch it for 10, 20, 30 years. Let's go into bonds first. Bonds are a very misunderstood investment because people think, oh, bonds are safe. They pay me 4 or 5% a year. If you are going into an individual bond, a United States Treasury bond, for example, that pays you out. You're good on that. You hold that for 30 years, no matter what, at the end of the time frame, you get your principal back. What most people, and I'm talking the vast majority, invest in are bond funds. They're going to have a bond fund at Vanguard, a bond fund at iShares, or some other firm. They don't understand that's not an individual bond. That is a bond fund, which is a collection of bonds. When you think about bond investing, you probably don't think about ever losing money, losing your principal, do you? When it comes to bond funds, let's get into it. As you see here, we have a bond fund pulled up. It's an actual bond fund. It's a Vanguard Intermediate Term Bond Fund. The goal of it is to generate a certain amount of yield to you, a certain amount of percentage payout every year. Here's the problem though. Bonds fluctuate significantly with changes in interest rates. So if you had a bond fund in 2021 when interest rates started to go up, what happened to you? Let's take a look. So as we can see right here, 2021, bonds started to go down a little bit. This is because interest rates started going up in 2021. Look at what happened to the bonds here. They started going down. And then 2021, you lost 2.3%. It still paid you out your set interest rate. We'll say for the purposes of this video, 4%. Your principal lost 2.3%. So net of your total investment, you made 1.7. But now let's go to the killer year, 2022. So you still would have got your nice little payout of 4%, but your principal would have declined by over 13%. So you would have been down 9% overall. They basically just paid you your money back. You didn't really make anything. And you still lost another 9% on top of that. Wow, that's a great investment. So now it's came back a little bit afterwards. 2023 up 6%, 2024 up 1.5%, and then 2025 up 8.5%. Here's the problem. Take a look at this chart here, and let's take a look at 2020. See this blue line? That's this actual bond fund investment. Here's your principal. You go all the way to 2025, you're still below what you would have initially invested. The principal has actually declined. Your overall base amount has gone down. And so we talk about safe investment. What's safe about minus 13%? Not much. That's not to say bond funds can never be good or they're always bad. It goes to the point of you really have to understand your investments, because this is how people get into bad situations, because they're invested in things they think are safe, but they don't understand all the variables of how they work, how they trade. Is it FDIC insured? Is it guaranteed by anybody? Are you in an individual bond, a bond fund? These are very big problems. Bond funds could be a part of your overall retirement income strategy, but you really got to understand the potential risks, and there are risks. That's bonds. The other aspect are annuities. Now, you can get some income annuities. They'll guarantee you a certain payout for life, and they'll usually have a base amount, but it's important to understand the surrender period, where you basically can't take out your money for usually 10 years. So if that's money that there may be an emergency come up and you need to take that lump sum, you're going to get hit with a pretty big penalty if you do. Important to understand that on annuities, there can be some growth, but the growth level is generally not going to be crazy high. On a fixed index annuity, there's no market risk. So you can't have this bond situation here that we discussed. There are fees on those. And so if the market is down 5 years in a row, guess what? Your principal's not going to grow, and you're still going to pay that fee every year. But that payout amount is guaranteed, even if you deplete that principal balance all the way down to zero. Most annuities, the ones that are, I guess, any annuity worth their salt, they're still going to pay you out anyway. So there's no risk of you losing that income stream so long as the insurance company stays solvent, which is the real risk there. It's important to understand the credit risk of your insurance company. You don't want to work with some obscure insurance company or an insurance company that is in financial trouble, because then if they go under, all of a sudden your payout stream is potentially no more. It basically creates a private pension for you, but you need to understand everything about it, everything about the company and the rules and stuff that kind of goes on with that. So the other two are money markets and CDs. Here's the problem with money markets. When interest rates are high, money markets are very nice. They'll generally maintain their value without really going up or down, but that rate is not locked in. It can fluctuate with whatever the interest rate is. If the interest rate is steady at 6% for that, it can be a good investment because there's no lockup period. There's no surrender charge. There's no requirement for you to hold it for X amount of time. It's fully liquid and it pays you out. The problem with that, though, is exactly what the benefits are. Because there's no lockup period, no surrender, no required holding time, they're not giving you a fixed interest rate. As soon as the interest rates go down or up, the interest rate you receive changes. So if we're at a period where interest rates are 4 and 5%, and then interest rates go down to zero, guess what? Now that money market is returning you zero. You got to pivot and go into a new strategy now because that's not a fixed rate. And so because of that, it's generally not a good long-term strategy. Anytime we've got to pivot and have a new plan, then we didn't really plan, did we? Planning is not just preparing for the expected, it's preparing for the unexpected. If you did not expect interest rates to change, that's not a good plan. It's not a very good plan at all, actually. For short-term holding, like if you have a lump sum of money that you're saying, hey, I might need this in 6 months to a year, money markets are typically pretty good. But for something that you want to generate a long-term income flow, that's generally not pretty good. Those are the various tools a lot of people use. I'd be happy to hear your opinions in the comments. If you like this video, make sure to like and subscribe. We'll see you on the other side.